Capital gains tax for non-residents. What do you need to know? Hi, I'm Kimberly Shapcroft, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. From a UK tax point of view, non-residents generally will pay capital gains tax on any assets that are based in the UK. So this kind of means that any properties you own in your own name as a non-resident, they'll be subject to capital gains tax, which is kind of expected and it's quite something we're normally aware of. This means at the point that you sell a property in your own name that you're going to be paying capital gains tax at the 18 or 24% rates at the point of release of this video. Check out if there's any changes in future budgets. And they'll be paid on that rate using a capital gains tax return which is completed within 60 days of the completion of that property. This will be for residential property. If you have other property such as non-residential property, commercial property, then this will all be reported on your income tax return that is completed for each tax year from the 6th of April to the 5th of April each year and reported by the 31st of January the following year. So that is really hopefully quite an easy one to understand. However, non-residents also get caught by something else. Now typically non-residents will not get any capital gains tax on any other assets such as like shares in UK companies. However, that is unless one of the following exceptions apply. And these exceptions are: they return to the UK within 5 years of leaving, or they sell shares in a company that is UK property rich and meet the conditions for an indirect disposal. So as we can see, if you're a UK resident, you've left the country and you return, then you're still probably going to be caught out by these rules. So that doesn't really help those. For those that are permanently non-resident and have never been a UK resident, then it may be you don't have a problem. However, if you have a UK property rich company, then you may still have an issue when you want to come and do something with the shares in your company. If either of these is fulfilled, then you'll have to follow through the normal capital gains tax process and do capital gains tax reporting on your income tax return, your self-assessment paperwork, which is in line with the tax year and is filed by the 31st of January. For a gain on any shares, this is going to be the value of the amount that you sell the shares for, or you gift the shares away if it's a connected person, less any cost that you paid, which, to be fair, is probably going to be relatively minimal because most of us pay £1 for our shares. Now, if you're watching this video on this channel, you're likely to be in property, so any company that you do have is likely to be a property company for property you buy and you let out. The definition of a UK property rich company is one where 75% or more of the gross assets of the company is within UK land, UK property. So most people watching this are going to be property investing, and on the basis you're property investing in UK properties, that means that you're going to have potentially over 75% of your gross assets, the total amount that you have as assets in the company, is going to be in UK property, which therefore means if you're looking at doing any reorganisations of shares in your property company, for example, you could be based in Singapore, Hong Kong. I speak to quite a few clients in that area of the world that are investing in UK property, and if that is the case and you want to, say, transfer some of your shares to your children, then just be aware that there is likely to be UK capital gains tax to deal with that, which means you'll be paying some capital gains tax to the UK government for the privilege of moving some of those shares across. If you are looking at transferring it to a spouse, there are still the spousal exemptions, so you won't have any capital gains tax in that situation. But if you are looking at selling those shares, if you are looking at gifting them, there is likely to be some UK capital gains tax that you just need to be aware of, that it will be impacting that transaction for you. And as a self-assessment system, that will need to be reported on your self-assessment tax return in the UK. If you don't usually do one, you'll need to register for self-assessment and then do that tax return in that particular tax year where potentially a capital gain has arisen. If this is a one-off transaction, then you'll only need to do a tax return in that specific tax year. So as soon as you've registered, done your tax return, you can notify them that you don't need to report anything else going forward and get yourself taken off the list, so you don't need to be continuing reporting on an income tax return and adding more admin into your life. As you can see, there is these additional complications for non-residents, but the more you're aware about them, the more and easier it is for you to deal with them, and make sure any tax planning is done in the right way to mitigate and minimise any UK taxes that you may need to be paying. This may mean that you need to make sure you structure things in the right way when you get started and bring children into the company straight away, or if, as I've seen a few clients doing, where you're getting a property per company, this can work quite well depending how you're managing things. It may be you need some of those companies not to just be your shareholdings or you and a spouse. It may be that you want to bring your children in at an earlier point of view to help mitigate any future potential inheritance tax complications if you are looking at keeping the properties in the companies indefinitely. Any changes with the shareholding will result in some sort of capital gains tax charge, which suggests maybe if you structure things in the correct way, you may not need to be taking that hit, and you can do some inheritance tax planning to mitigate any future potential inheritance tax in the UK as well. Overall, if you're thinking of making any changes to your property company, I definitely recommend you speak to your accountant in the UK to hopefully just make sure that they're considering all of these different considerations to ensure you're mitigating and minimising any UK taxes, whether it be capital gains tax or inheritance tax, as far as possible for as long as possible. And when you do find that you are coming into those realms, at least you're doing the right things to minimise any taxes that you may have to pay going forward. Hopefully today you've discovered what you need to know about non-residents and their capital gains tax position. If you have any questions, then please do leave a comment. Please like the video and do subscribe to the channel, and let's make tax less taxing. Let's make tax less taxing.